rent payable on property, it's giving you near on 7%. Sounds like a spillage. Brilliant. That's giving you like 7% return. So regardless, you should play the cycles, but if you just held on to it, broadly, if you bought the average commercial property in the UK, you're looking at 7% over the long term. So that's what the attractor is. Now, there's a very similar slide that Alex presented just now, but it's sort of like, it's more just looking over a 5-year period, and I've broken down the UK commercial into industrial, city offices generally, and then poor old retail towards the bottom, but still positive, and just comparing it to other assets and other types of investment classes across the globe. And broadly, UK commercial property is towards the top half of that. So overall, it's performed pretty well in the last 5 years. But looking at the most recent data, breaking it down even further, because we've got some excellent data. There's great transparency in the market in terms of understanding how the markets move and where you should invest your money. Now, I've broken it down in terms of from shops, retail warehouses, broken it down by regions. Now, that structural shift that I've already talked about, if you were into the last mile delivery, logistics, curb to desk deliveries, industrial, the unloved sector probably 10 years ago, you're probably looking at anything sort of like around 10-12% in terms of total returns over a 12-month period. At the other end of the scale, if you're holding on to those standard shops, those variety department stores, a much tougher market, because the perception of how people are changing, how we're shopping. So you've really got to make sure you know your commercial markets, and you've got to look for the best advice. Right, okay, so looking at investor confidence, has it been hit by Brexit? Just concentrate on some of the text over this side at the moment. The sentiment is showing that, there are some concerns around Brexit that we saw last year. But broadly, that's bad. But broadly, the market was only about 18% down year on year. This is total UK commercial volumes for 2019, roughly coming in around the £50 billion mark. But occupational demand, you'd probably be led to believe that Brexit was bad, it's going to be a nightmare, occupiers don't want to sign leases, you just don't know how the market's going to go. But just some of these bullets over here, the period, sort of like one of the best ever leasing periods in London offices, best period for leasing in the regional office markets, people outside of the M25 motorway. Logistics, second best year for logistics ever recorded. So the market is showing that there is that tenant demand. Tenant demand remained in the market. But it is worth noting that some markets, particularly China, Hong Kong, no real surprise, the money coming out of Hong Kong and deciding to try and get it into the UK did deplete somewhat last year, but we expect that to come back. In terms of the sectors, 100% bars, going back to 2000 in terms of that split. The only thing I want you to take away from this slide, offices is broadly stable, it's about 40% of the market, clearly driven by central London offices, by core global markets. But there's alternative and mixed use, mix of residential, mixed use property, people believing that to spread your risk, you should be investing in things that potentially have a much wider split and spread of uses within particular assets. So we've just seen that increase more over the last few years. Now, there's lots of things around occupationally that we look at. So let's just look at the retail market. We could look at London, look at the retail market. Luxury aspirational, newcomers coming into the market, wanting space in London, wanting new retail units in London in particular. And that's just been growing over time. So that's fantastic news for the central London retail market. When we can break it down, we can look at which particular sectors. You've got to be very forensic in commercial property, particularly in the retail sector, understanding where the tenants want to be at that certain point in time. So you can start looking at some particular markets. It's not necessarily about Bond Street, it's about the fringe of Bond Street in terms of new openings, occupiers wanting to take space. So where can I push my rents on? Where am I going to get those returns going forward? But equally, other places in London, you can buy and you can get hit by that structural shift. Not the type of shop that I would sort of aspire to own, but Clearly, people will still be owners of this. What do we do next? How do we repurpose it? How do we put this back into the community and create the next thing that is actually going to create value from this? So again, it comes down to advice and making sure you've got the best advisors to help you out. Just looking at sort of sentiment around offices. Offices, clearly the market is driven by employment growth. Forecasts going forward for the next few years, more and more people. There are slight blips. We've seen sort of like a slight Brexit-driven blip over here, but broadly, office occupiers are still employing more people, taking more space, regardless of any sort of more negative sentiment that we're seeing coming forward. And also, as a company, as Savills and day to day, we're tracking money, we're tracking capital raised as a forward indicator in terms of corporates that are going to want to take more commercial space. So usually look at these periods, 13, 15, 16, 18, 60% up. Capital raise, what do I mean by this? This is venture capital money being raised, private equity, IPOs, leveraged buyouts. It's just money going into corporates that will create occupier demand. As headcount growth grows, then clearly it's going to create the need for much more space. And 2019, slightly off the average that we saw the previous 3 years, but despite this Brexit year, it was still a lot of money swilling around, and corporates then having to do something in terms of spending that money, which includes employing more people. So overall, you probably would expect me to be quite positive, but the numbers do show you that there is a higher degree of positivity. So again, to the last few slides now. These are our relative return forecasts. We do a cross-sector because, of course, as a business, we can advise everything from your land all the way through to your residential, through to your commercial space. And we just broke it down, just looking at the next 5 years, those annual average total returns, where you should be thinking about sort of putting your money in terms of commercial for us. Again, that structural shift, that industrial, probably looking at around sort of 7.5% total returns on average per annum for the next 5 years. If you can get your hand on the stock, that's the key thing, is getting hold of it, because there's a huge amount of competition. So I'm sure the slides will be circulated, so you can look at these at your leisure, at the weekend, of course. Ring me up if you've got any questions. Now, so in conclusion, Brexit remains a risk. I've crossed out Brexit, and it's now all about Corona, of course. I've got no official view on Corona. I've heard one commercial deal has fallen out of bed that had a Chinese parent, but other than that, it's all fine. That's not an official view. UK looks quite cheap comparatively in terms of the yield you can offer and where you can buy property and the entry level into property. It's still quite cheap compared to some of our European neighbours. Urban warehousing, talked about that London, that last mile delivery. If you can get a hold of that, get a parcel delivery company in there, it's surety of income. It's a great thing to be able to get hold of. Good retail. Keyword, good retail is underpriced, but the expertise is vital. Making sure you pick, the fit to catchment is really, really key in this market. Office markets also becoming under supply. What do I mean by this? From about 2016, clearly the effects of the EU referendum result and decision, some developers decided, right, we can't really risk putting more stock in the market. We can't really start to build more stock. But as a consequence, in some of the key markets across the UK, on the office markets, there's a dearth of supply, dearth of new grade A stock. So we're starting to see much more of a development play there, but there's some great product if you can get your hands on that, of course. But we must avoid some degree of overconfidence. We've got to understand there is a cyclical nature of the market. It can change very, very quickly. So we've just got to be very mindful of that.